just waiting for the numbers of participants to rise. So please don't think there's a problem with your laptop or your computer and you can't hear anything. I do hope you can hear what I'm saying, but I'm just letting the numbers rise. Okay, we'll get cracking. Good afternoon, everybody, and welcome to the latest Institute National Online Branch meeting. I do hope everybody is well and remains safe. This is the last Institute National Online Branch meeting of 2020. As always, just to cover a couple of technical housekeeping issues for everybody. If we do have any technical problems, please bear with us. We will look to resolve those as quickly as possible. If you have a question, the Zoom webinar platform allows you to ask those questions through the Q&A button. Now, depending on how your laptop, your computer, your device is configured, you'll either find that at the top or the bottom of your page, but please use that to ask any questions. If it's a really pertinent question, I will interrupt today's speaker and pose the question. If it's something that maybe we could come back to or we could leave to the end, I will do that as well, but we will ensure that all questions are answered as we either run through or before we finish the session. I just wanted to cover a couple of things from an institute perspective. A number of you will have taken part in our national online branch meetings, our local branch surgeries, other webinars and series we've run since March of this year. But just to give you forewarning and an update, there are a number of webinars for you to make a note of, put in your diary, visit the Institute website for and register to take part. But tomorrow tomorrow afternoon there is a webinar with regards to monthly recurring revenue. We then go into January with a webinar on the 13th about supporting your clients with funding options. In February, the series that have been run by Matthew Shaw around accounting and financial reporting topics, we come on to financial instruments. The first national branch meeting of 2021 takes place on the 16th of February, is all about an employment law update. The Starting Out in Practice series returns in late February and runs into early March. We had to cap the current series that we're running due to demand, so we are running and reopening that into next year. The next extremely popular tax series takes place again towards the end of February and into March. The follow-up national branch meeting is on the 25th of February, and there will be throughout 2021 a number of local branch surgeries. You will receive local invites to those specific surgeries that we will continue to run. Other matters, we are getting towards the end of the calendar year. Politely putting it, the CPD requirement has remained the same. For anybody who's in doubt, the requirement from your institute is 40 hours of CPD to be completed between January and December 2020. 20 of those hours are verifiable, 20 are non-verifiable. I just draw everybody's attention and remind everybody about the COVID-19 resources page, the member support group. Both of those are found on the website. The 2021 member renewals and the 2021 firm renewals. Communications information has gone out to all members with regards to those. We would ask you to please respond to those communications, whether it be for your membership and, if it's applicable, your firm renewal. One, it is about the payment of requisite fees, but of equal importance are the completion of your member declaration and your firm return. Paying the fees without the declaration and the return is not enough. It's the fees and the declaration and the returns that's required. So please, if you've got any queries or questions with that, make contact with the Institute. We are here to help and assist. Enough from me though, on to today's speaker, and it's a pleasure to welcome Michael Fryer from Mattioli Woods. Hopefully a number of our participants, attendees today will be acutely aware that Mattioli Woods have been and are a strategic partner of the Institute and have helped provide members with and their clients with a range of advice over the last 3 years. The organisation are specialists in their arena of wealth management and employee benefits. Michael, as you will see from the slide, has assisted a range of personal and business clients with their financial planning needs for more than 20 years. His particular interest lies within estate planning, protection, of which he's going to talk about today, and of course using SIP and SAS structures. So Michael comes to this talk today with a wealth of experience and a background within the financial services sector. It's a pleasure to welcome him. It states there that Michael focuses upon the north of England and the Scottish belt in terms of his personal sort of client base, but he is joined by colleagues throughout the business who support members and their clients across the UK. Michael, can I hand over to you? Welcome to you. We look forward to your talk this afternoon. I'll let you share your screen and get going, but then I look forward to sort of joining you again with questions as we go along. But thank you for joining us this afternoon.
Many thanks, Jonathan. Thank you for that. Good afternoon, everybody. As Jonathan has rightly said, my name is Michael Fryer. I'm a senior consultant with Mattioli Woods with more than 20 years experience of providing holistic financial planning advice to both personal and indeed business clients, predominantly in the northeast of England, but also in the central belt of Scotland. And I'll be taking you through this afternoon's webinar, which will focus on protection. The purpose of today's session is really just to provide you with an overview of the types and uses of both personal and business protection, and the types which I find to be most commonly used with my clients, really. It's not meant to be an exhaustive review of all the different kinds of protection vehicles that are available. So if you feel that there's something that I haven't covered, please let me know and I'll try and address that. This webinar should take around an hour to complete, with me talking for around 45 minutes. But if you have any questions towards the end of the webinar, by all means, please let me know, or I'm quite happy for you to add a question during the course of the webinar. And if it's important enough, Jonathan will filter those through me and we'll deal with those as we go along. Ideally, I'd like to make this an informal session where you can really get something tangible out of it. So please don't be afraid to ask questions. So before I get into the real meat of things, really, let's talk a little bit about Mattioli Woods and who we are. Jonathan's been very complimentary about who we are and what we do, and just as by background, we consider ourselves to be one of the UK's leading wealth management and employee benefits companies who've been in existence since 1991. So we have getting on for a 30-year track record in financial services. We currently advise a little over 10,000 clients and have 9.3 billion of assets under management and advice. As you can see by the map, we have a range of different offices throughout the country, from Aberdeen up in the north all the way down to London, but our main or head office is in Leicester. While it can be said that we're perhaps best known as pension planning specialists via the SIP and often SAS route, we do take a holistic approach to financial advice and try and look at clients' circumstances in the round, as usually one area of financial planning impacts on another. This leads to financial planning solutions, including and can be used not just to build up a pension pot for retirement, but to help business owners throughout the lifespan of that business, and also to use a pension as a succession planning tool. We also provide investment advice, whether that be within the ISA framework, discretionary fund management, all the way through to more risk strategies, whether that be EIS or VCT, and of course protection, and it's protection that I'll be discussing in detail today. So in terms of agenda, as already stated, I'll be talking about both personal and business protection. And this is a very wide-ranging topic. So again, if there's anything that you feel I haven't covered and you'd like to know more about, please either get in touch with your local Mattioli Woods consultant or raise a question today. In terms of protection planning, I would really consider it best practice to have a dedicated arrangement for each protection need and almost build a suite of complementary protection policies to ensure full coverage. It's really a principle that we would call layering, so layers of different kinds of protection policies for different needs. So with personal protection, today I'll be setting out the features and the uses of term assurance, family income benefit, whole of life cover, and on the health protection side, critical illness cover and income protection cover. And while there are several forms of business protection that could and perhaps should be put in place by clients, today I'm going to focus on the most commonly used types, and that's relevant life cover and shareholder protection. Now, I'm sure we'll all agree since March and the COVID pandemic, we've been working under different circumstances, perhaps more stressful circumstances. And I'd just like to confirm that during those last months, Mattioli Woods have still been able to source appropriate protection cover for our clients, despite the fact that most of the major life offices have been adversely impacted by the effects of COVID-19 and the lockdown, and predominantly caused by people working from home. So the market is still open, it's still accessible, and we can still put cover in place. I think really we should start by considering why we choose to protect individuals or assets. What motivates us to do that? Well, in my opinion, and based on more than 20 years experience in the industry, this is to try to mitigate the impact of risk that we encounter that's unexpected and obviously beyond our control. And we encounter risk in everything that we do, whether that's driving our car or crossing the road, or perhaps even in the current environment, not social distancing. Risk and uncertainty simply can't be avoided. However, we can take steps to reduce the impact of the risk that we encounter by simply planning ahead. And this should really involve identifying what's important to us and then taking steps to protect that individual or that asset. And I would hope you'd all have a similar view to me and agree that our families are more important to us than perhaps our physical possessions. But recent industry data shows that us Brits are much more likely to insure our mobile phone against loss or damage than we are our health. And as a financial advisor, I find this attitude quite baffling. And it really identifies a protection gap in the UK that needs to be addressed. But I've talked a lot about protection already, but what do I mean specifically by protection? Well, in a financial advisory sense, this really means ensuring that sufficient funds are made available to those in need when they need it. And that's really the essential foundation of any sound financial plan. And this financial plan, if it's put in place correctly, can provide emotional security and peace of mind, and they shouldn't really be undervalued. So how can we achieve this peace of mind? Well, it should include looking at health protection, like critical illness and income protection. However, the first part of this afternoon's session will focus on the most frequently used form of protection, and that's life insurance. And in simple terms, life cover provides a cash lump sum in the event of the death of the person insured. An individual can choose to have as much life cover as they wish, assuming, of course, that they can afford the premiums and that a life insurer is happy to medically underwrite the policy and provide that stated level of cover. So everything's set up to put life cover in place. So why do we have a protection gap? Well, this is something that we need to address. A recent study from the Money Charity showed that 41% of those people in the UK that have a mortgage don't have any life cover to protect the debt. Those individuals are now experiencing risk of their own inaction, I guess. In the event of their premature death, it's likely that these families could suffer financial hardship and could even lose the family home. And that's a situation which could be easily avoided with some forward planning. I think the COVID-19 pandemic has reminded us all of our own mortality and the need to ensure that we protect those that are most important to us has never really been greater. To life cover in general, I just want to talk a little bit about insurable interest. And this is really something that we need to consider before making any kind of protection application, because without insurable interest, any form of insurance is void. And the definition, as on the screen, is quite simple, in that to have insurable interest, you must gain a benefit from the continued existence of an item or a person, or suffer loss from their destruction. So there has to be that link between the person or item you're insuring. Otherwise, that insurance is not worth taking out. The good news is that in the initial part of any protection policy application form, there are questions which determine insurable interest. So let's move on to the nuts and bolts of life cover. We'll start with term assurance, which is the simplest form of life insurance, and it's simply designed to provide a cash lump sum if the individual insured on the policy dies during a predetermined term or number of years. It can often be used for debt or mortgage protection because your mortgage will have a predetermined sum and number of years that it runs. So there's a nice fit, a nice synergy there. The planned term is always fixed at outset, but the sum assured can change. If we look at this graph, we can see we can go for level term cover, where the sum assured will retain the same throughout the life of the policy. Decreasing term assurance, which is often used for protection of a repayment mortgage. As the debt decreases over time, so does the payout from the life insurance policy. Then if you're putting in place term assurance to perhaps protect your family, it's important that that sum assured keeps pace with inflation. So we can build in indexation on an increasing term assurance policy, whether that be 2% in the example noted, or perhaps RPI or up to 5%. So term assurance is nice and simple. But there's one factor which I must point out really, in that term assurance often comes with the additional benefit of something called terminal illness cover. And this is often confused with critical illness cover. Terminal illness really is a clause which allows the life assured to make a claim prior to death occurring, so long as medical evidence proves that that individual is likely to die in the next 12 months. So essentially, it allows an earlier death claim, not an additional claim in any way. And that really should not be confused with critical illness cover, which is entirely different and is something I'll come on to shortly. In terms of cost, term assurance is the cheapest form of life insurance. And to give you an example, for a 45-year-old who requires £450,000 worth of level term cover over 20 years, a typical premium sourced just last week was £43 per month. I would point out that premiums do change over time in accordance with market conditions. Do you need me to stop and answer a question there, Jonathan?
Sorry, Michael, you saw me pop up again. Yes, I have got a question, and I think given what you're talking about, it's pertinent. If mortgage protection is set up on a reducing basis, is it tax deductible from the business?
Would we be talking about to protect a business loan or a residential mortgage, or a loan that's taken out to buy a commercial property?
Okay, thank you for that. Hopefully the person, it's Kishore who's kindly asked that. Our commercial property, they've just followed up with Michael.
Typically, we would look to use something like Relevant Life for that purpose because the rules are more clear cut. But yes, I guess that's more of a question for whether it's sort of wholly a business expense, and that's perhaps delving more into the accounts arena. And I would perhaps dodge that question and defer that back, if that's okay. But certainly, if it was to protect a residential mortgage, no. A grey area if it's to protect a commercial mortgage.
Okay, fine. Thank you. A separate question: can you advise how can we have an effective whole of life cover?
I can, and again, I'll defer that question because I'm coming on to whole of life cover after I've done term assurance.
Thank you very much. I'll let you get back on. Thank you.
No problem at all. Again, I was just saying that premiums do change for life insurance over time in accordance with the number of clients that are looking to source life cover. So in terms of supply and demand, obviously reinsurance rates. But once somebody's been accepted for cover and physically underwritten, you can opt for a guaranteed premium, which means that that premium will not change during the policy term. All life insurance really should be placed in trust. That's a very important point to make and a very important issue to raise. But I will come back to trusts a little bit later on in the webinar. Going to move now on to the second proponent of personal protection, which is family income benefit. And in simple terms, this is just a variant of term assurance. The sum assured and the policy term is still set at outset, but the way in which the benefits are paid are different. With the previous example for a term assurance policy, on death of the life assured, a single lump sum is paid and the policy ends. With family income benefit, on the death of the life assured, a series of lump sums are paid on an annual basis for the remainder of the policy term. And because of this staged payment, it's an ideal way of protecting a known expense, primarily university or school fees costs for kids or grandkids. And as the sum assured that could be paid out by the life assurer reduces over time, the premium payable is very, very competitive. In the previous example, we talked about a 45-year-old having £450,000 worth of cover over 20 years. For an equivalent family income benefit plan, where the policy will pay £45,000 per year, the premium is only £24 per month, so almost half. And again, family income benefit should be placed in trust. So in response to the previous participant's question, I'll now talk a little bit about whole of life cover. And as the name suggests, this differs from term assurance in that a whole of life plan doesn't have a predetermined end date. As long as premiums are paid, the cover will continue and the lump sum will be paid on death. So as this provides certainty in a payout, a whole of life plan is an ideal component of inheritance tax planning strategies. It's especially useful for those who are asset rich and cash poor, who maybe don't have the opportunity to gift assets to reduce the value of their estate, or perhaps they simply wish to retain access to their assets because they're perhaps anticipating future expenses, whether that be long-term care or whatever else. This kind of arrangement is typically established on a joint life second death basis to be inheritance tax efficient, because obviously on death of the first in a married relationship, assets will pass to the spouse free of IHT, and IHT then is encountered on the death of the second of the couple. And again, for the policy to be IHT effective, it must be placed in trust. There are two bases on which a whole of life plan can be set up. These again are underwritten policies, so medical evidence is taken into account, and that and the sum assured and the age of the applicant drives the level of the premium. But essentially we can look at what we call a balanced cover, or a traditional whole of life plan that offers a guaranteed premium. So that premium won't change during the life of the policy, but it starts at a much higher rate, as indicated by the axes on the graph there. More common is perhaps a low-cost whole-of-life policy or reviewable premium, which starts at a much lower level, and the premium is then guaranteed for the first 10 years only. At that 10-year point, and usually at 5-year intervals thereafter, the premium comes under review and it's likely to increase substantially. Yes, Jonathan. Oh, I think you're on mute there, Jonathan.
Okay, I still haven't learnt that. Apologies.
No problem.
Yeah, first question. Are payouts free of tax for insurance and assurance?
Yeah, any payout from a life insurance policy, critical illness policy, or income protection policy, the life insurance provider will pay that sum free of tax. However, if it's not held in trust, it will then add to the value of the estate, so then could be subsequently hit by inheritance tax.
Okay, thank you. And then I've got a question. Has there been any changes since 2012 with regards to whole of life cover? I took this one at the age of 30 for around £26 with increasing premium and cover, but I can't find similar deals available today.
There has. I was actually just going to come on to this. So it's a very pertinent question in that some older kind of whole of life plans weren't pure insurance contracts in that they had an investment element. So part of the premium that you paid for the cost of the life cover, and part of the premium went into an investment fund. Depending on the performance of that investment fund, at review points, the premium may not increase by as much as it ordinarily would, because you could use the investment element to subsidise your forward premiums. And if you surrendered or ended the policy, you could have a surrender value, so a return of that investment element to come back.
Okay.
There aren't any, to my knowledge, providers offering that kind of whole of life policy at the moment, and they're now all pure insurance contracts where you're physically paying for the life cover and there's no investment element.
Right. Okay. Thank you. Lovely.
Hopefully that answers the question.
Thank you very much, Michael.
No problem. In terms of the two different kinds of policy that we talked about, sort of low cost or I guess balanced cover with a guaranteed premium, when we deal with clients, we do offer both alternatives to find which suits them best. I'll now move on to talking a little bit about trusts, which I've alluded to previously. We're talking about term, family income benefits, and indeed whole of life. I'd like to expand on that a little bit now, in that there's almost a little bit of mystique about trust planning, but it really is very, very simple. A trust is really a legal agreement that gives control over who the policy proceeds are paid to when the life assured dies. So upon death of the life assured, the policy proceeds are paid to the trustees, and the trustees are then duty bound to distribute the policy proceeds to the beneficiaries. The trust has several advantages. It really allows the policy proceeds to be paid more quickly, because we don't need the need to go through probate to claim benefits via a trust. So usually on the production of a death certificate, the proceeds should be paid to a trust within a couple of weeks, which is obviously much more, has been expedited much more quickly than going through sort of the whole sort of probate process, which can take up to 6 months. But more importantly, a trust ensures that the policy proceeds don't form part of the deceased estate, which is obviously very important for inheritance tax planning. As a matter of course, all life cover should be placed in trust, but it's absolutely vital that whole of life, if it's set up on a second death basis for inheritance tax planning, that obviously the trust is used, otherwise the whole process falls down and it's not effective. Each life insurance provider has their own dedicated range of trusts, and these could be used without additional cost at the time of setting up the life cover. I'm not a lawyer, I'm a financial advice professional, and I would always recommend a client, if they're unsure about the trusts that we're talking about, seek legal advice. But most of the trusts available from life insurance are set up on one of two bases. There would either be a bare trust or a discretionary trust. The former sets out at application stage who the beneficiaries would be and how much of the policy sum assured they would receive. So, for example, it could be my son and my daughter, and each will receive 50%. Once the policy is risk and the trust is set up, the terms of that trust can't be changed. So more commonly, a discretionary trust is used, which instead of identifying particular beneficiaries by name, identifies classes of beneficiaries. So for example, my sons or my children, my grandchildren. This allows some flexibility for the trustees when the sum assured is paid into the trust, as after the trust has been set up, it's possible that other children could be born or other grandchildren could be born, and it allows flexibility in adding additional beneficiaries. It's very simple to put a trust in place, and the implications of doing so can be severe, especially if we're looking at whole of life second death in trust for inheritance tax purposes. So I'm really very, very confident that all of the clients that I deal with have the necessary trusts in place for their life cover. And I'd really like to pose a question if you could say the same for yourselves and indeed your clients.
Michael, I'm back again because I've got questions. So
yeah, that's good news. Let's make it interactive.
This is appropriate as well. Is it expensive to put existing policies into a trust? If not, then can the policyholder speak to the insurer and get this sorted?
They can indeed. All life insurance providers, as I said previously, have their own range of trusts. So if it's a simple term assurance or whole of life that doesn't have a tangible value, they can be put in trust retrospectively. That's not a problem, and that can be done without cost with the life insurer usually. A financial advisor such as ourselves or another financial advisor, if you have one already, can assist with that, or if not, you can approach the life insurer directly.
Okay, thank you.
If your trust planning needs are perhaps more complicated, you can see a solicitor to set up a bespoke trust. And obviously the cost of that varies, but for a simple life insurance, I wouldn't anticipate the input of a bespoke trust being needed.
Okay, thank you. And the second question I had at this point was, what would the premium for whole life policy normally be?
Oh, heck. How long's a piece of string?
Okay. I thought, do you know what? I thought there wasn't a quick answer to this one, but yeah.
That would really depend on the age of the applicant and the sum assured. So obviously, the higher the age, the higher the sum assured, the higher the premium is going to be. If that individual would like to perhaps message me privately, and I can certainly give them some indicative quotes with no sort of obligation. But yeah, it's an impossible question to answer, I'm afraid.
That's fine. I've got a couple of others. You asked for an interactive
session. No, that's good. That's all to the good. Yeah,
it's great to see this happening. If the proceeds are to be greater than the nil band rate, is there a charge to put it into trust and/or a 10-year charge?
In terms of the proceed, the sum assured on a whole of life plan?
I presume so, yes.
No, essentially they're not. I think there's a little bit of confusion there with chargeable lifetime transfers. So if an individual was to gift an asset or place an asset into trust that had a value of above the nil rate band, that would be a chargeable lifetime transfer. And then potentially be 20% inheritance tax to pay additionally on the value over the nil rate band. But simply putting in place a whole of life plan with a sum assured, of example, of £1 million, that doesn't trigger any sort of charge to inheritance tax at all, no.
Okay, all right, thank you. The next question, if a life policy is put into trust for the benefit of your wife and she predeceases the insured person, what happens to the funds held in trust, assuming you have no children or relatives alive?
Well, typically the trust document would state classes of beneficiaries if it was a discretionary trust. So it would make provisions for that. So it would say the first beneficiary would be my wife, but if she predeceases me, it would be another individual. So you can build that into the trust previously. If there is a lack of beneficiaries, so nobody to leave those proceeds to, again, there'd have to be some provision written into the trust about where those proceeds would like to go, whether that be to charity or perhaps even a political party. I don't know.
Okay. No. Oh, thank you. I'll let you get going again. Thanks, Michael.
No problem. Hopefully that helps with the trust side of things. I'd just like to move on now away from life cover and talk a little bit about health protection, and really start with critical illness cover. Critical illness cover can be a standalone arrangement, or it can be bolted on to life cover. So in the term assurance or family income benefit, or indeed whole of life examples that we've talked about previously, you can have critical illness and life cover in the same arrangement. But you wouldn't have two chances to claim. You could claim on one of either. And critical illness cover is really quite interesting if you're a bit of a protection geek like me, in that it was really the brainchild of a chap called Marius Barnard, who was a pioneering heart transplant surgeon in South Africa. And in 1983, he approached some South Africa insurers and said, look, we've got a problem here. Because of the work that I'm doing and advancements in medical science, patients that would ordinarily die would have life cover in place, and their family would have a lump sum of money to ease that transition into not having that particular father or mother with them. But because of his work, these people weren't dying, but they weren't well enough to return to work and earn a wage. So we said to these life insurance companies, what do we do about that? What can we put in place? And essentially, that was how the first critical illness arrangement came about. And it really allows an individual to make a claim on a policy on the diagnosis of one of a whole range of predetermined medical conditions. So death doesn't come into it. These conditions can be very common, but they're also very serious conditions. And it's also important to know that the ability to make a claim is triggered by diagnosis, not prognosis, which really means that your ability to recover or become well again is irrelevant. I think the best example I can use in this scenario would be a heart attack. It's quite reasonable to have a heart attack, be picked up in an ambulance, the paramedics or the consultants at the hospital to do an ECG test and diagnose that you've had a heart attack. That diagnosis will trigger a critical illness claim, which should be reviewed positively. If that patient is absolutely fine, fit and well in 3 to 6 months and returns their normal pre-heart attack life, that's fine. The policy proceeds don't have to be repaid. So this kind of cover can be very, very useful. The pie chart shows some brief statistics sourced by the ABI, the Association of British Insurers Claims History from last year. And for 80% of approved critical illness claims in 2019, cancer, stroke and heart attack were the cause. And 20% were a whole range of other illnesses. So you can really see that they are the main instigators of claims in this kind of cover. However, having said that, most modern critical illness covers protect against at least 40 prescribed individual medical conditions. Some providers exceed that list as prescribed by the ABI and go up to 50 different conditions. So there's a whole range of different things there that can be covered. And I would sincerely hope nobody participating today will need to claim on a critical illness plan, because by virtue it means you've become seriously unwell, but it is something that should be considered. The cost is higher than for life cover, and that's for a very simple reason, in that you're much more likely to claim on a critical illness plan before retirement than you are on a life cover plan. Typically, the cost is 3 to 4 times more expensive for critical illness cover than it is for life cover for the same individual with the same term and the same sum assured. One of the biggest objections I get from clients when discussing critical illness cover is, it's not going to happen to me, which of course nobody can say with any confidence. And what if I get diagnosed with one of the 40 or the 50 illnesses that isn't specifically named on the policy? The life insurance company won't pay. Well, most comprehensive cover critical illness policies have a safety net clause called total and permanent disability, which essentially means that if you contract another specific condition which isn't named, or perhaps they're in a road traffic accident, which means that you're unable to work due to that illness or accident, and this is set up on a specific own occupation basis, the claim can still be considered. So that's kind of a safety net clause there. So moving on to the final element of health protection, I'll talk a little bit about income protection. And in simple terms, this really is a private provision of sick pay. It can be set up on an individual basis or via perhaps our employee benefit team for a group of individuals within the company, but it's most often an individual basis. And we would look at a client's needs and determine how long can you last before you can claim on this income protection policy. Now, each income protection policy has a deferment period, so the number of weeks or months you can last or that you receive sick pay for. So in the example on the graph, an individual might receive sick pay from his employer for 26 weeks. They might have enough cash in reserve to cover their income and their income needs or their expenditure needs for another 26 weeks. So they don't actually need any benefit from an income protection policy for a whole year. In that case, we will dovetail the policy that although we will notify the life insurer of a claim when the individual is unwell, they're aware there's a 12-month deferment period, and if they're still unwell and unable to work at that 12-month period, the policy will look to pay a claim. An income protection policy pays a tax-free benefit based on your previous 12 months income, and that would be gross income, but the benefit is paid tax-free. Now, because HMRC doesn't want somebody to be in a better position financially when they're unwell and receiving benefits from an income protection policy than when they're working, there's a limit set to how much cover you can have. And that's depending on the provider between 60 and 70% of gross income. So you can almost get towards sort of net pay in this scenario. The policy will have an end date, which we would typically set at retirement age. And a series of claims can be made if needed. The old-fashioned name for income protection cover is permanent health insurance, and that permanent element really is in the eyes of the insurer. So once an individual has been medically underwritten and is paying premiums, the cover will continue until the end of the policy date. So it's possible to have a series of claims, even for the same condition, and then get well and return to work in between those claims, but receive a tax-free benefit while you're claiming. Again, the level of benefit can increase over time, so it can be index linked, which would be the usual way of putting these kind of arrangements in place, or they can offer a level benefit. I think we'll move on now just to talk a little bit about business protection. But before we do, I'd really just like to add some context, I guess, to the different kinds of personal protection that we've covered, which, to recap, was term insurance, family income benefits, whole of life, critical illness cover, and income protection cover. In general terms, the take-up of life cover is the highest across the board. It's much higher than critical illness cover and income protection cover, and part of that reason may well be that life cover has simply been available and been around a lot longer. But it's also to do with the price. Life cover is a lot cheaper than the other two elements of health protection. But when we look at claims experience, all of the evidence proves that an individual is much more likely to be unwell and not be able to work before retirement age than they are to die. So we're really in a bit of a topsy-turvy situation where life cover is the most frequently used element of protection, but it's probably the least likely that you'd need to make a claim on while you're working. So I guess what I'm trying to do is really stress the importance that we're almost lulled into a sense of security that we've dealt with our protection needs because we have some life cover. It's much more complicated than that, and income protection should be looked at first, as well as critical illness cover and life cover as well. So there endeth the little sermon on personal protection, and I'll move on now to talk about business protection. And again, I'm going to discuss the two most commonly used kind of cover in our experience, which is relevant life cover and shareholder protection. And relevant life cover is really very, very simple. It's really just a form of term assurance that we discussed previously. However, it's used by businesses to replicate or put in place death in service benefits for key members of staff, perhaps where the workforce isn't large enough to warrant a full service scheme. It's only available via a limited company structure, so sole traders or LLPs can't apply. And if it's set up correctly and the cover meets certain terms and conditions, the premium should be a business expense. But again, I would always defer to our accountant partners to confirm that with clients. The sum assured can be quite high in that it's based on a multiple of remuneration of the individual that we're covering. And that remuneration package can just cover PAYE earnings, bonus, and even dividends from company shares, but obviously not investment income. The scope of multiples tends to range between 15 and 25 times remuneration. With the younger you are, the higher level of multiple you would encounter. So if an individual was perhaps late 50s, early 60s, they'll be limited to 15 times remuneration as a sum assured. A policy must be set up on a single life basis only. The policy must be written in trust and it must end at age 75. On the death of the individual, again, the proceeds are paid into the trust and the trustees then pay the sum assured to the deceased's family. So it's a very handy way of a company providing an alternative to death in service benefits in a very, very tax efficient manner for employees. I'll now move on to the final element of protection, which again is a key interest of mine, and that's shareholder protection. And this is really, sorry, Jonathan.
No, it's all right. Before you move on, I've got a couple of other questions. First one is, if you have already had cancer and recovered, can you still take out a critical illness cover?
In theory, yes, but it may be difficult to get that particular policy underwritten and have full cover. It may be the case that after seeking medical evidence, that life assurer may say, yes, you can have critical illness cover, but we are going to exclude that element of cancer that you've already had. Mm-hmm. A lot would depend on the severity of the cancer. If it was invasive, and how many years you've been cancer-free.
Okay, right, thank you. Bit of a long one, so I'll go slowly, but please bear with me. I understand if a director of a company takes life cover through his/her company, and later, after a few years, if the business is sold or closed, then they may transfer the policy in personal name and continue to be insured by paying premiums through personal account. Please do correct me if I am not correct.
No, that should be entirely feasible. Obviously, if a relevant life policy is put in place with the business paying the premium, and that's a deductible expense. If the business is no longer in operation, the life insurer should be quite happy to maintain that cover as long as the premium is paid personally. Okay,
thank you. That's great.
Good.
Let you get on again.
Thank you, Jonathan. No, I'd just like to take the opportunity to thank everybody for participating. That's very pleasing for me to see. Yes, so getting back to shareholder protection, again, this is a real hot topic for me, really, not just with the higher incidence of interest in life cover because of COVID-19, but really because of the number of business people that I work with. It's a common topic that we discuss, and it sometimes is viewed as, oh, that's just more term assurance, Mike. Why do we need that? And it's really about forward planning again. if there's a sudden loss, individual who owns shares in a limited company, it can cause real disruption to the business and in some cases even jeopardize its future. Because if a key shareholder has died, it brings up the issue as to what happens to the shares that that individual owns. Does the business have the capital or the funds to buy those shares from the deceased's beneficiaries, his or her spouse or children? Could the beneficiaries decide to keep the shares and muscle in on the business and get involved in the business themselves? Or could they decide to sell them to a third party and that third party then get involved in the business? So you can see there are some real threats there to the business that need to be addressed. Now, every company will have articles of association which will set out the internal rules for selling company shares. But it really is best practice not to rely solely on those provisions and have in place a shareholder protection agreement. And yes, that will be a series of individual term assurance policies, again, written in trust for key shareholders, so that when or if one of those key shareholders dies, the sum assured is paid to the trust. The trustees pay that money to the deceased's family in lieu of buying the shares. The result being that the business retains control of those shares within the business, and the family have a lump sum to be able to continue the lifestyle. The one vital component of any shareholder protection planning is a cross-option agreement. And really, this is there to ensure that the surviving shareholders have the first option to buy the shares from the beneficiaries and maintain that continuity within the business. And the key phrase here is the option to buy. If the terms of the share purchase were considered to be binding by HMRC, this would more than likely be regarded as an obligatory sale, which could then jeopardise the availability of business relief on the shares. And I'm sure that's a situation that nobody wants to encounter. We need to make sure that that business relief is available for tax planning reasons. Now, we often come across clients who've been recommended to Mattioli Woods who have existing shareholder protection arrangements in place, where the cross-option agreement either isn't up to scratch or isn't in place at all. And this, I can't stress how important it is that is addressed, either by taking independent legal advice or through a cross-option agreement that's available through the life assurance framework. So I know that all of my clients, again, have trusts for their life cover and have adequate cross-option agreements for the shareholder protection. And again, I would pose the question to everybody participating on the call today, can you really say the same? If not, it's something you need to think about. I'd just like to summarise now, and thank you all for your participation. That's been very pleasing to see. And I'd just really like to stress that that is just a brief overview of the different kinds of cover that are available. In the COVID-19 climate, the need to review protections never, ever been greater. So, think about your own situation, speak to your clients, identify who or what's important to you, and get the protection in place. Mattioli Woods stand ready to help, but I understand you may have your own contacts, your own financial advisors, and it's more important to get that cover in place with someone than with Mattioli Woods, if that makes sense.
Michael, thank you. I've got a couple of other questions that came through just before you were sort of finishing that penultimate slide. Can personal insurance be converted into relevant life cover?
Oh, I would have to look into that, because I've never been asked that question before. I'm not aware of that being available. It would typically be a new application, a new underwriting, but I can certainly respond to that individual if they like to get in touch direct.
Yep. Okay. Thank you. Can a life policy be taken out on family or relative or family stroke relatives who are not living in the UK? Theoretically, if there was insurable interest, yes.
but many UK-based life insurers are reluctant to do that. If it was within the EU, I'd consider it, but what outside of the EU, I think you'd maybe struggle.
Right. Okay. No. Thank you. Thank you for that. I don't have any other questions at this moment in time, and I appreciate you've fielded and answered a good number as we've gone through the presentation, the talk. So thank you for that. Obviously, we're drawing to a close, everybody. So if you do have questions, now's the time to post them so that Michael can answer those. Can I? Just a plug in a polite sense for Michael and also his colleagues, actually, to all Institute members. You are aware of the Institute's digital platform, Financial Accountant. Mattioli Woods contribute an article per month to that platform. Michael's article, which is about to be loaded, is around the topic of protection, and will cover, a good number of the areas he's talked about today. But Michael and his colleagues have and will be contributing articles. So it's very much worth going onto the platform to just look back and look at what they've put up there, because it's really relevant and it's very useful information. There's me talking. I've got a couple of other questions. Can lupus patient get any life cover?
If we come across a client that has a particular medical condition, we would obviously discuss that with the client privately, and with their agreement we would typically approach a range of life insurers to ask them the question first and ask them what their additional requirements would be. That would then save time filling in a very long-winded 30-page life cover application just to have it rejected. So we have a good relationship with many life insurers and we'll be able to find out the answer to that question. Yes.
Thank you. You're being asked, Michael, to share or provide your email and telephone details. I don't know if you've got a slide after the summary, by the way. I know there is a follow-up either this afternoon or tomorrow from the Institute going out on behalf of Mattioli Woods to all today's attendees. Maybe we could get together offline just to ensure that that's provided.
Yeah, indeed, that's probably a little bit remiss from me. I missed out on an opportunity for some self-promotion, and I haven't included my email address or phone number, but I'm more than happy to provide those.
Right. Okay. Thank you. I'll talk to you and colleagues. That's great. Another question: in a cross option, can the family of the deceased refuse to sell?
Technically, yes, because it is an option to buy in terms of the remaining or surviving shareholders, and an option to sell on the beneficiary. So yes, there has been instances of that happening, and it does take a little bit of mediation or resolution work. Yeah.
Okay. And you talked about sort of the pandemic and COVID, I think, at the beginning, and the need to look at protection probably now more than ever. But probably final question of the day: do you think that if a person has had COVID, this will impact on the premium for life cover, etc.?
If it's for cover that's already in place and already underwritten, no. There's nothing that a life insurer can do to change the premiums on a policy that's already been underwritten. If it's for a new application, there's a whole range of medical questions which need to be responded to. And if there is an incident of COVID or indeed any other illness that would be noted on the application form, that would prompt an underwriter to either ask the applicant for more information, to arrange for a health screening, so for a nurse practitioner to visit the client and perhaps do height and weight check, a urine test, that kind of thing, or even ask for a report from the GP. Right. So that would come up in all of those checks and balances.
Right, thank you. To Geordie, who's asking me where will they find the article that I refer to that Michael's written will be posted within the next 24 to 48 hours. It's on the Institute's digital platform, www.financialaccountant.co.uk. If you can't find it, please get in touch with me separately and I'll help out there. Michael, can I thank you? A really thorough, very detailed and informative talk today. That's from me, but can I provide you with some feedback from today's attendees?
Yes, by all means.
We've got thank you, good topic, excellent presentation, learned a lot, thank you. Thank you for your brilliant presentation. Excellent presentation, learned a lot. I'll go down. Very good presentation, thank you. Thank you for an informative and interesting presentation. Finally, thank you, Michael, for the informative and interesting presentation. It's been real joy this afternoon to host this, because not only has it been interactive, but it's obviously hit a note with attendees, with members. The number of questions we've had along the way, I can see the sort of the questions and the chat still coming through, thanking you for your time. So on behalf of the attendees today, thank you. The question about slides has just been raised. We will be sending all attendees a feedback form on behalf of Mattioli Woods. If you can kindly complete that and return it, then the slides will be made available to you, but hopefully that answers that question.
Yeah. Yeah.
But Michael, again, thank you very much indeed. One final thing for me to mention, I forgot to include in the future webinars a webinar that we are going to host probably the 2nd to 3rd week in February of next year, which will be a question and answer session with the Institute's Chief Executive Officer, John Edwards. John will be hosting that session, but he will also be joined by Ian Hornsey, an IFA board director, and Ian Clark, the Institute's London branch ambassador. So an opportunity for John to update members as to where has the Institute been, where's it looking to go, but for you to pose questions of John and his fellow panelists. So a date is yet to be locked in, but please look out for that, probably the 2nd to 3rd week in February. I just think it remains for me to thank everybody for attending today. Thank you for your involvement and your participation. And once again, on everybody's behalf, thank you to Michael. Can I wish everybody a safe, happy and healthy festive period and season when it arrives? And can I wish all of you, your families and your colleagues, the best of health and best wishes for 2021. We look forward to seeing you in the future. Thank you very much for attending this afternoon. Keep well, stay safe. Thank you.
And thank you very much for allowing me to present today. And thank you for all of your kind words. Much appreciated.
Thanks. Thanks, Michael. Cheerio, everybody.